The multifamily market, particularly here in the I-4 corridor, Tampa and Orlando, has had explosive growth here in the last few years. Demand has remained strong and more or less offset all that new supply. We're seeing increased rent growth, pretty notable given the high supply levels. And investor activity has picked up as well, with rising prices and cap rates that have continued to compress.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, want to remind our listeners that we have a meetup group here in Tampa. So you folks in the Bay Area, of course, your Miami listeners and Naples listeners, and you guys can come too. But I know it's a little bit of a hike for you to come for a networking event. But the fourth Wednesday of every month, we have a guest. It's usually not recorded, so you got to be here to listen to hear what the guest has to say. And we have a little networking opportunity. So usually there's anywhere from 40 to 60 people that show up, and we try to make deals happen and talk about what's going on in the market and then listen to an expert in a particular sector. So if you go to our Facebook page or you go to our website at investfloridashow.com, you can find where all of those calendared events are, and you can make a reservation and put your name down and come on in and talk shop with Steven and I.
And Eric, you didn't mention about you came dragging in carrying all that beer and cheese and crackers and stuff. I can't wait for the one to start tonight.
Well, there's a lot of things we have to get people to enjoy themselves a little bit more and talk, get loosened up a little bit, talk shop. So that's it's always nice to share a beer or two with listeners. Wanted to also talk about the market a little bit. I mean, the market continues, and it's quite amazing, actually. And we continue to do transactions in all asset classes. Last week, we had a $4 million a sale of an office building, purchase sale that our agents did. They handled. There's a Bank of America transaction in Tampa, office transaction, obviously, office/retail on the ground floor for Bank of America place. Those types of deals are still out there, and we're continuing to transact. Of course, we're managers and brokers. We see kind of what's happening, and I don't see any slowdown at all, Stephen. I mean, our numbers are up this year over the previous year. So you got anything to add there?
Not only is it continuing, there's a lot of new development and new supply coming onto the market. So all of us have questions about where that's all going. And so that makes today's podcast topic really relevant because we focus so much on the transaction and the details. It'll be good to just take a bird's eye view. And we have Brian Alford talking to us from Costar so we can see what the market is doing.
Well, let's go ahead and get rolling with our guest.
Today we have with us Brian Alford. Brian works at Costar. He is the senior market economist based out of Tampa. His job includes observing data, covering and analyzing market trends and economic indicators and forecasts, and he generates written reports on both a market and sub-market level in Florida. Brian graduated from Georgia Institute of Technology and has a Master of Science in Business Management and a certificate in Finance. Brian's primary responsibility is geographical coverage, which includes Central and Southwest Florida. Brian, welcome to the podcast.
Great. Thanks for having me, Steven.
Hey, Brian, really appreciate you taking the time and investing with us today. Why don't you give us a 30,000-foot view of how you got to where you got at Costar right now, and you're in research, correct?
Yes. So my current role falls under the umbrella of research. My role is a market economist. I'm a boots on the ground analyst here, based out of Tampa, and I'm part of a relatively new initiative where we are analyzing the markets from within the markets. It's a little bit better, a lot better actually than covering it from afar, which is kind of historically how it was done. And I've been in the role for 2 years. I cover Central Florida. I originally kind of backed into commercial real estate. My degree was in finance in Atlanta. And I have been in the industry for the last 14 years, primarily in a financial analyst role, senior financial analyst role on the brokerage side. But I've been doing this for about almost 15 years now and really love what I'm doing.
You do all asset classes or just multifamily?
We do all asset classes. The main function of my job is to put together the market and sub-market reports. Right now, that's really just the four main food groups, which is retail, office, industrial, multifamily. But we cover and analyze all sectors.
Okay, so just for the record, today we're going to focus really on the multifamily sector.
The I-4 corridor, yeah.
Yeah, and then perhaps at some other points we'll talk about some of the other sectors.
Awesome.
Yeah, sounds great.
So obviously multifamily is the largest asset class in terms of sheer numbers, also in number of investors. So it is the asset class that we get the largest amount of questions on. So why don't you just give us a 30,000 foot view of the I-4 corridor, where we are today and sort of where we've come from to at least get the ball rolling.
Okay, no problem. The multifamily market, particularly here in the I-4 corridor, Tampa and Orlando, has had explosive growth here in the last few years. Both markets were hammered pretty hard by the recession, so a little bit late coming out. But household formation and job growth have been well above the national average since about 2012. The construction levels didn't really start picking up until about 15 or 16, so construction has lagged the demand pretty significantly. And about a year and a half kind of lag between the national markets. But over the last, I would say, 3 years or so, the vacancies have really continued to compress. They're about the lowest rate that we have tracked them ever. So really the markets are effectively in equilibrium. Both are characterized by some of the largest or the largest supply waves that have happened in the last 3 years and still ongoing that they've ever seen. Despite that, demand has remained strong and more or less offset all that new supply. We're seeing increased rent growth, pretty notable given the high supply levels. And investor activity has picked up as well with rising prices and cap rates that have continued to compress. So overall, very, very healthy multifamily markets.
Brian, when you're talking about demand, where is there the highest demand? Is that an equilibrium? Because it seems to me that there's an overabundance of high-end multifamily coming onto the market. And are there enough people to absorb and pay those rents? And are we meeting the supply and demand for the middle sector?
Yes. So everything that's been constructed, for the most part, has been your luxury Class A space. There have been a lot of concerns voiced to me that perhaps we're overexposed there. I would say that in particular, just looking at Orlando and Tampa, at this point, thus far, there's been no trouble absorbing that space. But to be sure, the strongest demand has been your workforce housing. So B and C has been strong. That's where most of the jobs have been added. And there really hasn't been any increase in the inventory over the majority of this cycle. That has been where most of the rent growth has been. But I don't think we're necessarily overexposed on the Class A. I think there's still strong demand there. If you look at the job growth in both metros, while particularly in Orlando, it skews heavily towards your lower income leisure and hospitality, you're seeing high job growth across all sectors. So pretty much every median income level is seeing high job growth. You're seeing high formation, but it is noticeably stronger in your workforce housing.
Can you give us sort of an idea from bottom of the market, depending on who you talk to, somewhere around 2010, 2011, to where we are in that Class A space in terms of per square foot rent and cap rate to where we are today? Just a general rule of thumb.
Yeah, let's see. So the cap rates today, Orlando and Tampa, they've compressed pretty consistently throughout the cycle. They're in the low 6s, 6.2, 6.4 range. And they really are about 20-year lows at this point. So the thing that's really noticeable with the pricing here is that we've seen nationally pricing has kind of flattened here over the last year and a half or 2 years. Whereas in Tampa and Orlando, the pricing has just continued to go up and up and up. Where we are today, I think the caps they have started to slow down. They're starting to flatten out a little bit. Being at almost a 20-year low, it's really tough to see the caps going too much lower, compressing much further than they are. But certainly they've been outperforming the nation here for the last couple of years.
And is there any differentiation in the cap rates? Because we just said that there's going to be a greater supply, or there is a greater supply of new Class A coming on. Have Class B and C cap rates been compressing at a faster rate?
Yes, most of and just speaking from my calls that I get, the anecdotal experience I have, most of the institutional investors that are they're looking for the value add, that BC inventory, well located. So they're still getting pretty strong yields that are continuing to compress, particularly in the B and C sector.
Mm-hmm. And do you guys also do forecasting, or are you sort of more rear view mirror type of analysis, Brian?
So we do both. We analyze, and we also we put out a 5-year forecast as well.
Okay. And so can you give us sort of a 30,000-foot view of what that forecast looks like?
Sure. We expect, given both supply waves, particularly in Orlando plateaued really in 2017. We're seeing decreasing starts and less units underway. Looks like Tampa also has plateaued this year and is on the decline. So we don't really see any fall off in demand based on household projections and job growth projections. So we're expecting the markets to more or less stay, at least over the near term, in equilibrium. Rent growth has been phenomenal. Orlando's the number one rent growth metro among the top 24 metros in the country. It has been for 3 straight quarters. But I think we're going to see rent growth begin to cool a little bit. 6.5%-7% annual rent growth is unsustainable.
Sure.
Tampa's been doing pretty well as well, but the 4.5 to 5 range. So I think we will see the rent growth start to come back down a little bit. But given how tight the markets are, how little competition from the housing inventory levels being low, I think the rent growth should stay pretty strong, elevated, probably still above average. And investment activity, we're seeing the cap rates really are flattening out, so we're projecting them to kind of flatten out going forward. I think the volume will stay pretty high. We might see the volume start to decline somewhat, but I think we're going to see still considerable investment activity throughout the metros.
So, Brian, what are the rental rates today as compared to where they were during the recession?
Right. So at the bottom of the recession, we had the overall asking rate about 96 cents a foot. We're doing much better today. It's increased. We're sitting at about $1.24, $1.26 per foot. So we're about 30% higher than we were at the bottom of the recession.
Gotcha. And that's on average across all asset classes, correct?
Correct, yes.
Okay. And let's talk about Tampa versus Orlando. What are some of the characteristics and maybe hot spot, trouble spots that you might see out of each one of the markets? How are they different? How are they the same? And then what are the things that you might want to look for to say, oh, this might be an issue?
Okay. So we'll look at Orlando, and both markets, to be sure, are doing phenomenal. But Orlando, the demographics there, it's a little bit different. It's the youngest metro in Florida. The only metro in Florida that has an actual larger component of your prime renters, your 20 to 34-year-olds, as compared to the national average. So Orlando typically is positioned well historically for demand. They've also got UCF, the second largest university, a lot of spillover demand there. So when you're looking at the really BC demand drivers, Orlando's positioned very, very well. Tampa, by contrast, it has a little bit more demographic shift towards financial institutions. It's an older metro. You've got older households with usually a little bit more disposable wealth. Now, historically speaking, that would not be as positioned as well for absorbing multifamily and being a demand pool. But as we talked about earlier, all of the supply has really been in the luxury sector. So I find it interesting, and I think that Tampa might be positioned a little bit better to absorb this top-heavy supply, given the older households and the number of households that are in that kind of retiring baby boomer sector that can't afford the inventory, whereas Orlando could have a little bit more trouble, I would think, absorbing some of this high-priced supply.
Didn't stay in a Holiday Inn last night, and I'm certainly not an expert on like you are on this stuff, Brian, but I look at it from my viewpoint of, and we deal in smaller apartment complexes, not necessarily in terms of when we're selling, not the development side of things, but I look at all these Class A's that are coming up right now and getting completed, the related project in the center of downtown. I know the same thing's happening in Orlando. These larger projects, Frameworks is in the process with it. They just finished one over in Harbor Island and another one on the north end of downtown. And these are Super A or double A's or AA, whatever people term them as, are really nice apartments. But I think we did a tour of the related group one here recently, and the 3-bedroom apartment with one parking space is over $5,000 a month. And I look at average household income in the Tampa metro, and I just wonder, it's not unique. Obviously related, that 3-bedroom unit is at the top of the market, but how much do you see anything there that you're saying, oh gosh, I don't think average household or the number of households that are making the kind of money to live in a $5,000 plus per month apartment. What do you think about that?
Yeah. Orlando and Tampa both have relatively low median income levels. So if you're looking at it just from the median income level, it certainly looks daunting, the amount of Class A space and high dollar space that's been added to the markets. I've heard the concerns as well. The only thing I can really have to go on is the last 3 years that these units that have delivered thus far have not really struggled in the lease up. We've seen, like in Orlando in particular, it went from about a 4.5-5% annual rent growth market to the number one metro in December. And the reason it surged to number one was a rebound in the Class A demand. A lot of that is fueled by the downtown growth. That's where most of the units are located currently that are underway. So looking at the performance of the markets, they are absorbing it thus far. But I agree that if you look at it from affordability, it looks suspect. If you look at the percent burden placed on the typical renter in both markets, it's continuing to go up and up, particularly in Orlando. So that's where I think that these rates are unsustainable. I think that we're going to have to see some rents start to come down to continue to absorb the tail end of the supply wave.
So really, in terms of asset class, if a developer or an investor can somehow develop or purchase middle income Class B or Class C, it seems it might be less risk for them in the long run. When you look at the data and looking at the areas between Tampa and Orlando, are there any geographic areas that you think are pockets maybe for opportunity? Lakeland's growing pretty fast.
Yeah, Lakeland is doing phenomenal. I would look at areas where you've got, especially if you're looking at some of the more workforce housing, value add kind of properties, I would look where that job growth has been. I would be more suspect of areas that have been very highly concentrated with construction here in the last 5 years. Particularly downtown Tampa is building really heavily right now. A lot of Class A space being added. In Orlando, the same thing. Also, the Lake Mary, Sanford area, a lot of high-end construction there in the last 3 to 5 years. So I would give those areas that have seen a lot of recent supply added a little more scrutiny.
Do you guys look at all into tenant behavior? In other words, are they taking additional roommates, or there's any sort of data that you do when you kind of look at, maybe it's, more single mothers, professional mothers, or, people taking on roommates to help share the cost, to try to transfer some of the expense per square foot to others? Or how are you, or do you guys do any of that type of analysis, Brian?
So, yeah, we do somewhat. We have a team of national economists that also look at that. And that kind of data we look at to look at more of the national trends. I don't think we have as granular of a data down to maybe Tampa and Orlando. So that's not something that I personally study a lot for my metros here, but we do look at that on a national level.
Okay. And then what are you thinking about, or what are you seeing on the institutional guys? Are they just as strong in this market as ever, or are you seeing them soften on a little bit, and maybe it's more individual investors that are taking down some of these on the transaction side?
So institutional activity is definitely increasing. So 2015, 16, 17, that was the three largest years for both metros in terms of sales volume. So looking at just 2015 compared to now, 20% of all transactions were institutional investors. And in 2018, we're about three-quarters in now. It's up to 23%. There's also been an increase in REIT activity, which was about 7% of the transactions in 2015. That has doubled today. So it's about 14% of the 2018 transactions thus far. When you're looking at institutional and then also the REIT side, it's gone from about 27% of the pie just 3 years ago to about 37% today.
So, it wasn't too long ago that institutional investors, if they were going to look at Florida at all, they'll look at Miami and that was it. Are you seeing a geographical spread into the tertiary markets now? Are they getting more comfortable with that?
Yeah, and it correlates right when the sales volume really started picking up, especially when you had the kind of primary markets such as Miami or New York or San Francisco, as those caps started to get really, really low, down in the 4% or sometimes lower range from what we would hear. A lot of the institutional capital started searching out higher yields, especially in these high population growth metros. And Central Florida was positioned very well to capture some of that capital.
Yeah, so Brian, I think that's a pretty good wrap on the multifamily market. It's interesting that you're covering all different markets. I hope we get the opportunity to discuss some of the other segments with you and see if they're performing a little bit differently.
Okay, absolutely. I'd love to talk about other sectors.
Yeah, no, it's all these things move in unison, and obviously things like job growth and types of jobs and wages and salaries play a big role in what's going on in the apartment market. So we'd like to be able to tie some of this stuff up with you at a later date. So, but Brian, we definitely appreciate your contribution today and your investment of time with us. Stephen, anything else before we let him go?
No, Brian, if people, you do a lot of research and I know you publish a lot of original material. I'm not sure if that's for the general public or only for Costar subscribers, but if people wanted to reach or some of the information that is available, how could they get it?
So a lot of the reports that I do are for Costar subscribers, but I'm also putting out news pieces on really about a weekly basis. Those are public facing. They should be searchable. We are also looking at putting together a public-facing kind of snapshot of each metro. So you'll get kind of a high-level picture of all this data that we're talking about. I don't have the date on that, but I know it's coming very soon. Also, anybody can reach out to me at any time, and I'm happy to discuss any of the markets, what I see going on, regardless of whether you're a client or not. I always take something from every interaction. I learn as much as I give, so it's very, very productive. I find every conversation worthwhile.
Well, except for the ones with Stephen.
Yeah, that's because I go to Costar meetings and I'm busy eating. So Brian, just one thing that we actually were talking a little bit before, and you said that you went to Georgia Tech, and I just wanted to tell you that even though I grew up in South Africa and I was born there, my father went to Georgia Tech, and I think I was the only 2-year-old in Johannesburg that used to sing, "I'm a rambling wreck from Georgia Tech and a hell of an engineer."
Yeah, well, it sounds like you were the coolest 2-year-old.
I did, definitely.
South Africa.
Well, I don't think I've ever heard coolest at Georgia Tech in the same sense.
Yeah.
That's awesome, Brian. Really appreciate it, buddy. And until next time, we'll definitely loop back with you and see if we can't talk shop with you a little bit more on some of these other asset classes.
Okay, great. Thanks, Eric.
Thanks, Brian.
Thanks, Stephen.
And that was Brian Alford from Costar talking multifamily on the I-4 corridor. Stephen, anything that surprised you from our discussion?
Well, Eric, as we suspected, there's an overabundance of new development coming in the luxury area. The great part about talking to Brian is he looks at all this data and then just paints a pretty little picture. So it seems to me the path for success for an investor is to try and find a way to cater to the demand that workforce housing needs, and look where the job growth is and try and go there. It's a tough challenge.
Tough. Dirt is so expensive, and the construction costs.
Yeah.
I mean, guys that in 2017 brought on projects and entitled projects in 2017 and started building this year, they just got their face taken off because construction costs have come up so much. It's tough. I mean, construction costs are high and land costs are high. And how do you get that, $1,200 a month, 2-bedroom, 3-bedroom apartment built? That's hard, but it's necessary because the job growth is here. It's that market's tight.
Yeah, it's to thread that needle.
Exactly. Stephen, anything else before we let our listeners go?
It's certainly interesting hearing from Brian and getting the snapshot of where we are in the multifamily market. We'll be looking at other segments of commercial real estate, and the place to go to look and get all this information is go to our website, to www.investfloridashow.com, and download the app so that you can listen to it while you're driving or in the gym.
Perfect. Guys, as always, we appreciate the time that you invest with us. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.